After selling 698 Strangles, this is exactly what I found that actually works. And you'll be surprised, it's actually pretty simple. And just to kind of let you know and show you, this is the up-to-date statement from one of my accounts. So you can see I'm up about 15.2%, and currently I am in a natural gas position. So just to kind of show you that I am basically doing exactly as I explained, which I think is really important. So let's quickly begin with the stats. I'll go over it very quickly, and then we'll go over to what actually works, which you saw on the very first slide at the beginning of the video. So it's short Strangles on futures, and I only trade or these are all the products that I have traded. Now, not all of them are pretty good for short Strangles, and I'll explain each and every one in a second, but these are all the products that I've ever sold Strangles on. This is my win rate, and about 93% win rate. Many Strangles. The difference now is I'm probably way more efficient, but I began with about $10,000, give or take, and the average yearly return turns out to be 51% per year. Now, not every year is 51%. Some years were more, some years were much less. Especially COVID year was, I think, 30% maybe, which is also not too bad, but it was a pretty rough year to get to the 30% return. Now, the total profit is that I've made personally is about $398,000, and the thing is, it was before taxes, and I just made a mistake of not consulting with an accountant, and I've paid a lot of taxes on this money. So it's the profit is not as big as it looks like, because a lot of it went to the taxman here in Canada. Now, my biggest drawdown on the account was realized and including unrealized was down 22%. Most of it was unrealized, and it was actually during March 2020. Now, I did finish the month down 7% in March 2020, but obviously back then I was trading a bit differently, and there's a lot of things that I did not understand, and obviously I did not have a lot of the statistics and knowledge that I have. My average winner to my average loser ratio is 1 to 1.21. So for every dollar for every $1.21 I risk, I can make $1. Now, again, these are averages including my really kind of bad trading that even though it was still profitable, but still it was a lot of things that weren't exactly optimized. So this is what actually works, what I'm doing nowadays, and I'm working with well over $3 million overall, and it's been really good lately, or in the past since 2023 has been really good for me. 2023, 2024, and then this year is also I'm up about 15% realized and unrealized. So short Strangles, and I only trade these 10 products. So these 10 products are what actually works best that I found, and there's very specific matrices on how they work best. So there's two ways that I will only sell a Strangle. Is I will sell a Delta 20 Strangle, where the short put is Delta 20 and the short call is also Delta 20 with 45 to 120 days to expiration. I will probably never go under 45. In very specific cases I might, and I probably will never go over 120 days. Some specific cases I might, but usually this is the range that I'm staying at. This range gives you a massive kind of cushion if the price does become somewhat volatile. My take profit is 50% on these Strangles, and my stop loss is at most at 50% of credit. Sometimes I put my stop loss at 40% of credit, and this is plenty of room. Now I will be risking up to 4% of my capital per trade, and I know some people will say this is too much and this is not enough. Not enough of a big. It's not a big enough stop loss for the position to be wiggle around, and it is actually. I have a lot of data, and my stop losses were anywhere from 200% of credit to then 150% to 100% to 75%, and then 50% is pretty optimized, and now I'm even testing 40% to 45% to begin with. And obviously, as the position is getting better and better, you definitely want to decrease your stop loss from 50 to maybe 20-30% depending on how profitable the position is. Really important to do that. And also position sizing is everything, because when you sell options on futures, The margin requirements are usually pretty small because they use span margin, but at the same time, margin can really expand. So if you collect a lot of premium and then things just gonna go sideways, but the price is still well within your strikes, you might be out of the position for a loss just because your position size was too big, collected too much credit, and margin requirements are just out of hand and you have no way to deal with it. Now, the second way I would ever sell Strangles is I will go to delta 10 or lower, and I will sell a Strangle with 90 to 120 DTE. Now, these are basically low delta, high DTE Strangles. These ones, the take profit is 30 to 50%, usually 50. Some cases I will take profit at 30% because sometimes these positions get to 30% in like a day or two. So it's kind of worth it to just be out of the position that quickly. Now, this is a bit more of an advanced kind of trading, and you have to really keep position size even smaller than the 4% here. But again, it kind of depends on your risk appetite. But there is no stop loss, so you need to know advanced defense techniques to be able to control your margin requirements and to control your P&L. These are the two things. And usually when I trade these positions, I only have one at a time. Never really have two of them at a time, because you really have to focus on one position and be able to play defense if anything goes bad with it. Now, if you want to know about those advanced defense techniques, they're not that fancy, but they're pretty advanced. Just email me below. I can kind of explain, but it's not as simple as it is, and you kind of have to understand the numbers really well. But this works really well. You are in and out of a position much quicker than you are with this method, with a delta 20. And obviously the margin requirements cannot be more than 40% of the account at any given moment. So basically per position, and you probably want to keep it way lower than that. So up to 30% when you open a position, and you really want to follow the margin. So these are the two things that absolutely work, and I tried everything in between: delta 16, delta 30, delta 30, everything. This is basically what gives you what I've been able to get the best win rate and the lowest amount of, I guess, stress, because stress is a big thing, a real thing. So using these two methods, this is how I've been able to get the lowest amount of losses. Probably not the best return. You can probably get a better return, but drawdowns will be definitely more visible. But given with those two methods, my drawdowns were, I don't know, I think probably I've had like 3 losses in the past 2.5 years. So I think that says a lot. So and all 3 losses were not full losses. So or actually I think one of them was a full loss, but the other 2 were pretty small losses because I keep moving my stop loss as the position is getting better and better. Now, next thing is price must be trading in range, and let me show you exactly what it is. So as you can see, we'll go over all of the commodities in the list there just so you see exactly what's going on. But basically, you can see this is the daily chart, sorry, on gold, but price is definitely not in a range. It's very directional. Look at silver. Well, silver, the price is in a range, even though it's a ugly big range, but it is going sideways, right? So this is what I mean by price moving in a range. Copper, kind of the same thing. You don't see a trend the same way you see in gold, where it just goes up and up and up and up, at least currently. Crude oil, somewhat in range, not really. It's kind of broke down, but it's still somewhat in range. I won't really consider this trade as of right now, but again, depends on what kind of strikes you choose and or what kind of range you get for the strikes with delta 10 or delta 20, and then what credit and so on and so forth. Now, gas, for example, it's a position that I currently have on. You can see it's basically kind of moving sideways. You don't really have much of a directional movement, even though if you zoom in, you can, I guess, count this as a downtrend and this is an uptrend, but we're looking at the way bigger time frames. And this is basically my strikes here, and you can see how far out, and this position currently is up like 27%, I think, as right now as we speak, and profit target is at 30%. So been a pretty good position. It was opened just May 2nd, so not bad at all. Now let's look at the grains. So grains, you can see it was in a range to a certain degree. Now it's just kind of going downwards. So you cannot really open a position here because it's basically broke the range. Corn is kind of at the bottom of the range. You definitely want to open a position once it's somewhere in the middle of the range. We have soybean. Soybean is definitely in a range. You can see it's very clear to see. This is a position I opened on a demo account, and you can guess what happened. It worked out pretty well. And we have soybean meal, which is somewhat in range, but it's on the bottom side. And actually, this is an expired contract. I need to change a contract. And then we have soybean oil, which was in a range for quite a while. Now it's breaking out of the range and now back in. So we're definitely not going to be touching it. But it's very clear what's in a range. You can easily tell, okay, this is trading in a range. This is not so much. And gas is also somewhat in range. So hopefully this kind of helps out, because this is probably the biggest key. Now, a few key things. So natural gas cannot be traded from October to March, because this is in the winter season. There's a lot of volatility. Natural gas is used for heating households in the wintertime in the US and Europe. So there's a lot of volatility because the supply and demand balance is really off. So sometimes there's more demand and sometimes there's less, and the supply kind of goes up because companies try to match the supply to the demand based on the weather forecast, but then the weather forecast changes. So a lot of volatility. Every winter there's a lot of volatility. So I never trade natural gas during these months. And then summer months are usually the best months. Now, I also never trade any of the grains. So between April and July, just because this is the harvesting and planting season, and there is a lot of volatility during this season. It's kind of known, happens every single year. So I just don't touch these products during these months, natural gas and all of the grains. And these are just rules of thumb, because if you kind of get into these products, you will suffer at some point. I can guarantee that. But usually they're trending anyways, so then this condition will not be satisfied. The price will not be moving in a range. But sometimes it is in a range, just beginning of April, and you enter a position, and then it just kind of gets out of the range, and you're just gonna eat a big loss for no reason. Now, the last and biggest thing is you really need to learn and understand what affects the supply and demand balance for each and single product. It's extremely important. This is also probably one of the big keys why I'm still in the game. Of course, you need to have all the data and have all the mechanics, right? But this is the biggest thing. So I'll give you an example. Let's say you are currently in and this is actually a real situation. The current month, let's say it's March 2024, and you have a position on copper. Everything is good. Everything is by the rules. But then some news come out that there's possibly the biggest mine in Chile for copper has collapsed. Now, they don't know the extent of the damage just yet, but some reports of the mine being collapsed came out. Now, obviously, these are pretty big news that will affect the supply side of this equation. So in this situation, I would just go ahead and close the position right away, because you never know what's going to happen. But this is pretty big news, and what happened. We can actually take a look, see here what happened. Let me go to the copper one, but basically the mine did collapse, and you can see here I go March 2024. So you can see exactly also where I had a position, open it right over here, closed it right as the report came out. And then I think this position was closed actually for a bit of a profit, because it was open for quite a while. But then you can see what happened, because it was confirmed that the mine has collapsed. So supply goes down, demand stays the same. So price will just shut up like crazy for quite a while. And you can see beforehand the price was basically moving sideways for copper. So these are the things you have to follow, and I do have a full course on YouTube, and I do kind of like let people trade with me. If you're interested, just email me below. I have my email address in the description and also the course in the description. But this is basically the very, very basics. The only things that I would kind of really want to work on after kind of looking at this video is this: number one, price must be trading in range, so to make sure that you know exactly what it means and you can identify it easily and rule out what is not in a range clearly, and also that you understand the supply and demand balance for each and every product. And there's only 10 of them, really not that many. And I already gave you some clues with natural gas in the winter and seasonality for the grains. So if you have any questions, let me know, message me, email me. If you want to join my Options Academy, where you basically trade with me and learn that way, I think it's also pretty beneficial. And that's about it. Thanks so much for watching, and I will catch you in the next one.